This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusanya. Welcome to the show. Welcome to the pod, ladies and gentlemen. We've got a fascinating episode lined up for you. I am joined today by none other than Laurentius van der Wom. Laurentius, welcome to the show.
Thank you very much, Abram. Great being here.
Yeah, I don't think you need any more introduction to the audience.
I don't need any introduction either way. It's not my show. I'm just here to ask a couple of questions. We've got a great guest here as well today.
Yeah, incredible. So we've got Rob Edwards, CFA, who's the Global Head of Product and Research for Indices at Morningstar.
Yeah, thanks, guys. Great to be here. Thanks for having me.
Welcome to the Rob. Welcome to the show, Rob.
Appreciate it.
You're originally from Ohio and you moved to London for the weather, I'm told.
Yes, no, London's beautiful. Yeah, I grew up in a very small town. I always tell the joke that my high school growing up had a drive your tractor to school day. So if that kind of situates you like where I grew up. But yeah, I spent a long time in Chicago before coming to London. So I can probably do a whole podcast on my move over to London. My first day, at Morningstar in London was supposed to be April 1st of 2020. So we came right during the pandemic. So I came, landed, and then spent, a year and a half in and out of lockdown. So I had a very interesting international experience starting off.
Fascinating. Let's not get into that. Okay, so let's take us back. Give us a sense of your journey. The journey from that led you to where we are today as the head of products and research for Morningstar Indexes.
Yeah, I think probably like a lot of people, I landed in indexing kind of accidentally. I was working at another role. I've been at Morningstar a long time, almost 13 years now, starting off in our headquarters in Chicago. And I was working on our institutional platform, Morningstar Direct, and I noticed I was working with a lot of wealth managers, a lot of asset managers. I noticed how sticky and complex of a business indexing was. It was something, going into the industry, I don't think, you give a lot of thought about, but, index providers provide a service that is very important. I always say it's a great business to be in because almost every, financial participant needs some sort of benchmark data, whether you're an asset manager, asset owner, an individual kind of retail client, like you need this data. And it struck me pretty early on in my career how important, a part that index providers play. And then I did some work with the, Morningstar's index team, and I came there around 2017. So I saw an opportunity, and I moved there, around 2017 when our business in the U.S. and globally on the index side was still, very small.
So it's fascinating because Morningstar obviously went into the start creating its own indices. Maybe you can give us a sense of that. And now you are going even bigger with the acquisition of CRSP.
CRSP. It is an actual acronym, Abram.
It's Center for Research and Center for Research in Security Price.
You nailed it.
Which is originally part of the Chicago.
University of Chicago.
University of Chicago. So maybe you can tell us a little bit about dimensional.
I could give you the full history of the index business at Morningstar because I think it had a very different journey than I think of other index providers. If you look at other index providers, how they've kind of, grew up, they were really there to provide kind of an information. And, if you look at any, name one of the big indexes out there, they really started off, kind of as a paper portfolio to track what's going on in the market. If you look at Dow Jones or anything like that, they've been around a really long time. Morningstar, I think, came to indexing through more of, I would say, kind of research and intellectual property. So the first kind of foray into indexing for Morningstar was our style box indexes. So I think Morningstar is very well known for a couple things, our style boxes, our star ratings for things like mutual funds, And so, a provider approached us of creating ETFs at the time on these different style boxes. So we utilized that to kind of kick off the business in 2002. And I think for a long time, where we've fit in the industry is utilizing Morningstar's intellectual property. We have a large independent equity research team. We have all of this mutual fund data. We have, we own other brands like Sustainalytics on the sustainability side, PitchBook on the private market side. So that's really been kind of our heritage as an index provider is using all these different components that Morningstar has. And you're right, we've really kind of, I would say, doubled, tripled down on our index business in the last, 5-6 years, before this CRSP acquisition. When I started in the business, we were 30, 40 people. In I would say around 2019, 2020, I think we put a lot of investment into the business to start scaling it. We've historically seen ourselves as a challenger brand probably the last 15, 20 years, and I think with this acquisition of CRSP, it's moved us more I would say in the mainstream ecosystem, right along with the biggest index providers. We have something a little over $4 trillion in assets tracking our benchmark. So it's it's a large pool of capital, and so I think there's a lot of responsibility as an index provider to be a good kind of steward of our benchmarks, because it impacts a lot of people, myself included, and retirement savings, things like that.
Who are these fund managers or people in this 40 trillion that you've mentioned? We've read about Vanguard obviously being big adopters of CRSP. It seems like they are continuing that relationship, but who else? And is it mainly US focused? Is it UK focused? Are you bringing the US business model towards the UK, or is the focus also just a bit more intellectual property?
I can maybe go into our strategy in Europe in a second. I think our business has historically been Morningstar's headquartered in Chicago from Joe Mansueto. He founded the company out of his apartment. It's a really cool story. I would say our providers are large asset managers predominantly. So BlackRock uses a lot of our indexes for ETFs. We have a great partnership with a firm called Van Eck, who uses our moat philosophy for their indexes, which has been really successful over the years. Both in the US, Europe, Australia, kind of across the globe. So JP Morgan. So it's the big kind of brand name asset managers that have been using our benchmark. So again, I think historically they've been more focused on whatever you want to call it, strategic beta, kind of high IP, semi-active type indexes. But I think the last 5-6 years, we've been really focusing more, on the beta space. And, maybe next steps we can get into later is focusing on what we think is kind of the next frontier is, private markets benchmarking. I think
interesting.
Yeah. And I think in terms of Europe, I came over here 6 years ago to kind of help, I would say kind of kickstart our European business. We already had, a nice solid base of clients, but I think we see ourselves as a great challenger brand in Europe. And I think, again, we have all of these different pieces of intellectual property that I think resonate, especially I think, our partnership with Sustainalytics, which we acquired, 4 or 5 years ago now, has given us a really big boost in the market. I think there's still a lot of demand for sustainability focused products, and especially in this institutional market. So that's where we've been kind of breaking in to the European market. But I think in terms of things like CRSP, we plan. We really want to bring that more globally. I think it does have a fit in the market outside of the US too. So that's going to be a big part of, I would say, our strategy going forward.
Yeah. So maybe you can speak to this CRSP origin and this academic origin in the US, because I mean, when we wanted to bring proper benchmarking and indices into the timeline ecosystem, we obviously spoke to all the existing index players, and then we found that Morningstar Indexes could do what we wanted to, but at the time, a lot of the data, a lot of the indices went back to, I think it was, 1990s, and then you've now extended it to the 1980s, late 1980s. And then when I saw that news that you're buying CRSP, which had this very deep historical records of asset classes, share price in the US, I thought there is something going on there. So tell us a little bit about that academic heritage and how you're maybe thinking about.
Yeah, and I think CRSP was a real natural fit for Morningstar for a number of reasons. I mean, one, both Chicago based. I mean, so it was a really, there was a lot of kind of synergy there. But yeah, I mean, the heritage of CRSP, goes back to the 60s.
Right.
So I mean, it started really with kind of a research project. So, it's evolved into this really kind of dominant force within academia.
Yeah.
If you see anyone that's writing a paper that involves security pricing, I've been told by academics, if you don't use CRSP, it almost invalidates some of your research. I mean, I think that's how prominent it is within, the academic community. So I think it's it was a natural foray for them into, benchmarking and in their relationship they've had with Vanguard for a long time. So, there's a lot of really interesting things they do. And I think they have such a foothold into the academic community. And I think it brings a lot of credibility to what we do as an index provider. So, when people utilize one of our indexes, they know there's years and years of kind of, thought leadership and research into these, they might seem like small decisions, but, I think there's a lot of thought and research that goes behind, what CRSP has developed.
Yeah. Shall we jump into the main
Elephant
point,
in the room?
Yeah.
When it comes to index investing and index construction? I think the main thing this year was mega cap IPOs.
Yeah.
You guys wrote a brilliant article around it and why it's not such a big concern and why the concern actually comes down the road a little bit later. Walk us through it. Maybe just talk to us about what are the...
No, totally.
Why is there so much noise in the market around these mega IPOs, and is it just overhyped or not really?
Yeah,
or more precisely, did you game the rules? Did you change the rules just to let SpaceX and a couple of the bigger ones in?
Yeah, no, it's been actually really funny because as an index provider, we usually kind of live behind the scenes, right? I think asset managers usually, rightfully so, get a lot of the attention. So with these, mega cap IPOs, we've been very much, forefront with the media and things like that. And some of it's been positive, a lot of it's been not so positive. I mean, if you read some of the media, you would have thought like Elon Musk was personally knocking at our door on some of the stuff, and that really is not the reality. So in terms of, if you take a step back and just look at how the market's been changing, I mean, I think it's a huge kind of macro trend. I think what is really driving this is that these private companies have been staying private for much, much longer. I think if you look at 10, 15 years ago, what would happen is, these companies would IPO as small caps. And then if they were successful, they would kind of ride the waves into kind of the large cap space. They would IPO mostly small kind of mid cap space. These companies are generating enormous value before they go public. So what does that mean for us as an index provider? Our job, on the equity side, basically, and the CFA does a good job of actually like laying out kind of what makes a good, benchmark. But really what we're trying to do as an index provider is to accurately reflect the passive composition of the market. That's our job. So the question we had to ask ourselves is, can you tell the story of the market without including some of these, mega cap companies? And I think the answer is no, right? And so I think there was criticism in the market because of index providers changing their rules. But, my rebuttal this whole time has been, well, our job is to accurately reflect the passive composition of the market. And how do we do this, the most efficiently, transparent way? And again, I don't think you can tell this, if you look at the value that SpaceX, for example, IPO'd at, you can't really tell the story of the markets, without them. So, and I think the paper really kind of dug into, okay, then with that being said, what is the actual impact of it, right? And it goes into a little bit of the nuances of benchmarking, which I think, a lot of your listeners probably won't be super familiar with. So there's this concept of a float or free float, which is basically the amount of shares that are readily available to the public. So if you look at any large, equity-based benchmark, almost all of them are free float market cap adjusted. So they're adjusting for the weight of the actual index by the amount of shares that are kind of readily available to the public. So with SpaceX and a lot of these big companies, they're so large, they don't need to release a lot of their float, and they don't want to do that for a number of different reasons. So they have this kind of low float number. So what happens at initial IPO, For example, for our total market indexes from CRSP, it's a very small percentage of weight in the benchmark to start with. So it was around 15, 20 basis points at IPO in these kind of broad US benchmarks. So it's small to begin with. And what happens over time, and we go into this in the papers, especially around 6 months, like a lot of these investors, kind of pre-IPO investors, their shares get released. So they'll sell them into the general public. And so that float number will increase pretty dramatically around 180 days, like 120 trading days, right? So you will see probably over the next 6 months, and we'll talk about kind of index rebalancing here in a second, but you'll see that number, that weight of the index go up, especially around that period. So probably not a huge deal to start with, but it will grow over time. Of course, some of this has to do with how the actual securities perform. We could talk about SpaceX and how they perform, but that's really kind of what happens for an index. So I can go into more details, but I'll pause there.
Are we talking basis points here or percentage points?
We're talking basis points.
Yeah, I have the numbers from
please.
one of your other post on this.
Yeah.
So it goes, SpaceX entered the US total market index, the CRSP, total US market index, currently followed by that index is followed by more than 2 trillion in investor assets at, wait for it, 0.15% weight, making it the 106th largest security in the index. So it doesn't even come in the top 100.
Yeah.
And all of this noise. But to your point, when the lockup ends, you're likely to see that ratchet up. Is that
that's right. So it's kind of a gradual process, and for most index providers, we do this process called index. You might hear index reconstitution or rebalancing, but that's resetting the membership. So we'll review things like the outstanding shares and float of these securities. So it's not like it happens just at a random point in time. We have a very set schedule. So index providers, the way that we work, we're very transparent and rules-based. So any investor can go online and see the rules for any of our, market-based indexes and see the timing. So, this will happen at a predetermined schedule, essentially.
Yeah. And I think maybe taking it then one step further.
Yeah.
This all touches on the main issue we have been facing the last couple of years, which is concentration.
Yeah.
And I don't like the word magnificent 7 anymore, because I think there's probably now a magnificent 9 or 10 already.
Mangoes
and
or whatever the next term is.
And then you have these IPOs, call it SpaceX, Anthropic, OpenAI, all sort of competing for that top 10 position in terms of total market capitalization.
Yeah.
What's the impact of these IPOs in the total index? Is it concentrating the indices even more? Is it deconcentrating the indices? And is the biggest impact we're seeing on those already fully invested companies like your Apples, your Microsofts?
Yeah. I think it's yet to be seen, right? But I think at origin, like at IPO, and we talk about this in the paper, there's very little impact on the top 10 securities. But concentration has been a huge thing. I mean, it's yet to be seen. Again, it's going to go back to, performance of these. If SpaceX, it's, I can't remember, I looked this morning, $130, something dollars. If it's $1,000 in a few years, then I'm expected to be in the top 10 holdings. If it doesn't perform well and the business doesn't take off, then, it probably won't, right? So I think that has been a huge phenomenon. I looked back yesterday at the top holdings, in 2016 versus now. I mean, the concentration of the top 10 holdings in the U.S. index is almost 3x what it was just in 2016. So this is a long-term phenomenon. Interestingly, that's not only the case in the U.S. If you look at the emerging markets index, it's almost exactly the same. 30+% of the weight in the a broad emerging markets index is also in the top 10 names. Interestingly, it hasn't happened in Europe. Europe is still a lot more diversified. It hasn't had this boom of companies that have huge weights in these indexes.
Do you ever consider the fact of capping a specific holding? I think we get concerned. We get concerned around concentration in the US, but then if you look at your largest holdings, it's 4 point something %.
Yeah.
when you look at indices like South Korea, which, well, probably now more than 50% is just two companies, Samsung and SK Hynix. Do you ever talk about the issue of capping how big can a weight be of a certain company, or do you just completely leave it to the market? That's what passive investing is.
Yeah, all the time. And I mean, I think part of our role as an index provider is kind of to act as a consultant. So I think it depends on how you're using, the index. And obviously in places like Europe, in Europe, you have UCITS cappings rules. So some of it is purely, regulatory driven. So if you want to passively track an index, you just don't really have a choice. I think if really what you're trying to do is show the reflection of the market, I think we always say, look at the uncapped version, because that is, again, the reflection of the market, which is, the story that we're trying to tell. So, in broad, US, Europe, or developed markets, emerging markets, these broad indexes, it's not really an issue. And I don't think you should really dive into capping unless it's a regulatory issue. But if we're talking about, the Danish market, and I think it was last year, Novo Nordisk was 45% of the Danish index. So there's maybe certain situations where it makes sense, but again, I think it goes back to how you're going to use the index. If it's more of a the original use case again for indexes, which were more kind of a market research tool showing what's the performance of the market. It's uncapped. If it's more, you do want to have an ETF or a fund or something like that, and capping maybe does make more sense. But there is a trade-off, and I think that's what we try to educate people on is what's the trade-off of the capping, because there is unintended consequences of that too.
What do you make of this criticism that because you have researchers, academics, boards, making this decisions around what goes in, how the index is constructed, and so therefore, what do you make of this argument that it's therefore not passive, it's therefore not it's active because you got somebody making decisions? What do you make of that?
Yeah, well, I think the criticism, I think it's great. I mean, I think it's I think it's great that everyone in the industry is holding each other accountable, right? So I think it's great that people are asking these questions. They should hold index providers, asset managers accountable. We should have to explain ourselves and things like that. So I think I welcome the criticism, because I think it's great that we're holding all kind of financial participants accountable, right? As an index provider, we do have a lot of process, in Europe, especially, like we are regulated through, us personally through, through benchmark regulations. So we have to do certain things in terms of, issue consultations and talk to the market. Mm-hmm. So we have a lot of structure in terms of whenever we want to do these things. And again, as an index provider, we're very kind of transparent in terms of how we make those decisions, when those decisions. So I welcome the criticism, because I think it's healthy for the industry. Now, in terms of this decision in particular, I think we made the right decision in terms of, again, like what our job is of an index provider, which is to try and accurately reflect the passive composition of the market. If we sit on our hands and we don't react to, changing market dynamics, then I think we're not doing our job very well. So I welcome the criticism, but in this, I think we made the right decision just based on like what's happening in the markets today.
Mm. Do you want to talk about it?
I want to touch on this whole topic of indexing is gonna lead to Armageddon.
Yeah,
it makes the markets inefficient. It distorts the price discovery mechanism. Some people call it the index effect. You've got all these researchers, fund managers now saying that you can actually quantify this basis points that we are leaving on the table, because index funds are all rebalancing at the same time. We know exactly what they can do, so we can an active manager can just front run them. As an investor, you are leaving basis points on the table. That's not necessary to do. Yeah. What's the defense to those arguments? Yeah, no, just like I welcome criticism, I also welcome active management, right? Like I think, my rebuttal has always been, well, if you can predict what these indexes are doing, then you should have a pretty ample opportunity to beat your benchmark, right? And I think,
for the majority, if you look across, the majority of Morningstar categories, we group different funds into, kind of like-minded strategies, and in not many of them are beating their benchmarks on a longer term basis, on a 3, 5, 10-year basis. So I think I welcome active management because I think it is that counterbalance. So I think if you look at kind of academic research, there's research on both sides. I think there's research that says actually indexing makes price discovery much more efficient in markets. There's ones that will, say the sky is falling because of benchmarking. But I think we welcome active management, and there is certain areas in the market, especially in fixed income, I think where there's probably better opportunities because of the mechanics of benchmarking, where you can beat your benchmark. So I think we welcome active management. I think there's always going to be a place for active management, relative to index investing. So I think there's, both those things can happen.
But I think even with that, even given that index funds can cause a bit of inefficiencies during those rebalancing periods, you do have some tools that you utilize or deploy to get around it. I think CRSP is relatively well known for the way they trade over certain days. Can we maybe talk about those tools that you guys employ to just be trading a bit more efficiently?
Definitely. And one thing I will say, like if you look at all of the assets tracking benchmarks, it's not like it happens on one single day or something like that. So if you look at like our Morningstar's competitors, we all do it at different times for the most part. So it's not like, May 15th, all of these benchmarks across the world are changing, right? So, we have a different schedule than all of our different competitors. And I think that's actually helpful because, there's a timing element to it when all of these different things are changing. So in terms of like how you actually execute this, so this is going to get a little bit in the technical details, but again,
please,
I think, when you look at how indexing works, again, we go through a process several times a year for our equity benchmarks, where we're rebalancing. So we're adding new constituents, so new, stocks, removing stocks, and that can be for a number of different reasons. Stocks may have, fallen off the market cap spectrum, so they're microcaps, so they no longer qualify. And you do that in a certain, period of time. So you have these things called, pro formas, which are kind of forward-looking files in terms of how the benchmarks are changing. Most indexes, you essentially, if you're a portfolio manager, you'll execute those changes on a single day. CRSP has a methodology called packeting, essentially, where you're essentially, because of the size of the assets tracking the benchmark, are doing that over a number of days. So instead of trading on a single day, you're also doing that over kind of a 5-day period. So we call it packeting, basically. So you're kind of trying to dampen the effect of any of the securities, making it easier for a portfolio manager to trade.
And these things are all being done on the index level, but then also on the fund management level, you do get your budget of tracking error.
Exactly.
They even can do packaging themselves.
So we give them we send them, essentially, we send them, we're sending them the ingredients. They're baking the cake, basically. That's how I kind of describe that process. And, portfolio managers for an index fund, they have lots of different kind of technical ways that they can employ that. They don't have to buy every single security. So there's different techniques that they can use. That starts getting very advanced, but they typically have some sort of budget that they can. And you can also get into like physically replicating, actually buying all of the securities, or synthetically replicating portfolios by using different financial instruments. So that's when it starts getting very complicated that we don't need to get into. But there's different ways that portfolio managers, so they have a tough job because a lot of their activity is in kind of a short window. But they have different tools that they can kind of manage these index rebalances.
Yeah, the thing I find interesting about this is like the whole process of index reconstruction is so transparent. So that market participants kind of have an idea of what's going on. And everybody has an opinion on whether or not it's good or bad for investors and all that stuff. Yet, do you think that there is have you guys seen any sort of tangible evidence that if you take SpaceX, for example, that, active investors can systematically game the inclusion of these securities and, the changes in the lockups and the reconstruction. Have you seen any evidence that they can systematically game this to outperform?
No, it's a great question. I mean, I always go back to, if there was a way to do it, there would be people doing it and making a lot of money off of it, right? So, if there is some sort of imbalance, it would get solved really quickly, right? Because there's a lot of really smart people looking at this data, right? So if there is some sort of inefficiency, I would say would get solved like almost immediately. So I would say from a long-term basis, no, because, if there is some sort of, other side of a trade or something like that, people are going to figure it out really quickly. And, the people are good at making money off these kinds of things. So, it creates efficiencies, very well. And, I always go back to, I think if you look at research with passive investing and all, in index investing, it's been one of the best wealth accumulation tools of like the 21st century, right? Like it's led to really, I think, good investor habits in terms of, dollar cost averaging and not trying to, buy the needle, find the needle, just buying the haystack. And we can get into some of those numbers, but I just go back to, I think this has been, one of the best wealth accumulation tools of our generation, right?
And are you worried about this, increasing concentration? If we don't know how, the likes of, Anthropic or OpenAI are going to change this concentration, but like psychologically, do you worry about likely increasing concentration?
I don't really. I mean, again, if you go back and look at if you look at the one of our large U.S. indexes, for example, take a snapshot in time of the top in the holdings over the last 100 years. Those names are going to, change as the economy changes. So I'm not worried, because I think the world is going to evolve. Like right now, AI seems like such a predominant theme. 10 years ago, it was something different. 10 years ago before that, it was something different. So things are going to evolve. And I think, Professor Bessenbinder at Arizona State just kind of re-released some of the research that he's done. And the reality is, most stocks don't outperform treasury bonds. It's a very small amount of companies that actually drive the performance of the whole market. Something in the last 10 years, something like 40 companies has driven more than half the returns of the market, right? So I don't worry about it, because
that's 40 companies, not 40% of companies. 40
has driven more than half, almost half of the market returns, right? So again, it's really hard to choose winners. And so even if you miss 2 of the 40 companies, you're likely to outperform, right? So I think
I have seen that interpreted as, do you want to hold all the other, 2,000 companies? I've seen some active managers saying, actually, just hold the 40.
Well, you can, but I think it's buying those 40 at the right time, right? So if you look at the weight, and again, that's why if you look at the top 10 holdings in 2016 versus 2026, there's some of the same names there, but the weight is doubled or tripled, right? Because they've been really successful.
Right.
So did you want to own those names over the last 10 years? Yes.
No,
Do you want to own them over the next 10 years? I don't know. I can't tell you, but the index is going to reflect that composition anyway. So unless you think you have great information, and then you're better off buying the index, right? And you can talk about thematic investing too. I think that's when you really get more kind of heavyweights to names like SpaceX really quickly. There's been a number of launches of space and defense indexes or ETFs out there. So that's where you probably get a heavier weight of these things more quickly.
I think on that specific topic of concentration, one thing that used to be a very big talking point was regional concentration. And we've started out a couple of years ago with index funds mostly being adopted on a regional building block basis. So, obviously started out with the Vanguard or the US stock index. And then if you take it to the UK, you would have your UK building blocks, specific building blocks. And then we sort of adopted just a global index strategy. and people got concerned around the US being 65% now of a global index. Is that something that is still such a big talking point, because these companies are, quite frankly, global companies? How do you think about regional concentration if you design an index? Is SpaceX or Apple, for example, a US company only, or do you actually see the risk divided amongst all the other countries as well?
Yeah, no, it's a great question. And I think it really comes down to, part of it comes down to like where you sit in the world. Obviously, Morningstar's done some research on this. Like there is a huge home bias wherever you live.
Right.
So if you are sitting in the UK, maybe you do, maybe you want more exposure to your home market. So I think it really depends on, what you're trying to accomplish. Obviously, US investors, they have a huge percentage of their portfolio to U.S. investments, and it's done quite well recently.
And
right?
That's even more than the 65%.
Even more, even more than that. So there's a large home bias wherever you look. A number of years ago, we built these indexes that were kind of multi-asset benchmarks. Mostly used for wealth managers, and I think what we found when we looked at that is Canadian investors, UK investors, European-based investors, they all had a strong home bias, for better or for worse, right? But they all had a home bias because they know the companies, in their backyard, so to speak. They know they know the market, they know the kind of economy, and they're more invested in that. So I think it depends on what you're trying to accomplish. I think building blocks. Obviously, you have you have a much more refined approach, especially if you're an allocator who has capital market assumptions. So you have a bet that the U.S. market's going to do terribly versus Europe, whatever that, and that showed up really strongly last year, right? Where we finally had this comeback of the ex-U.S. market. So last year would have been a great time to have if you had high conviction on valuation, and I think some of this comes back to kind of a valuation conversation. If you're looking at a building block approach, from a valuation standpoint, maybe that's where you want to use building blocks. But if you want to say, I just want to own the whole market and like let the winners kind of shake out, then I think the global approach. So I think there's pros and cons to each, but it depends on where your convictions are and where you're sitting geographically in the world, and what if you're a financial advisor, where your clients are sitting.
Yeah. Do you see, so Morningstar Indexes has these global indices.
Yeah.
And do you see somehow that how, bringing CRSP into this equation helps you extend just the historical data behind these global indices as it stands currently?
Yeah. I mean, I think it's a big question for us to tackle. CRSP, again, they've built what they've done starting in the 1960s.
Yeah.
So it's not like they did this overnight.
You can't go back.
and I think CRSP has done such a good job of just putting data quality first. So they even have, identifiers, which is rare, where you can follow a company over time. So if you think of if you think of Ford Motor Company, think about how many corporate actions, mergers, acquisitions, spinoffs that single company's been through. So you can actually track that with CRSP data. So starting from scratch, I think, is going to be very, difficult in European markets. But it's something I think we definitely want to explore. And I think there's appetite for it. I've talked to a lot of academics in Europe at the largest institutions. They would love to have that data. So, I don't think it's something that will happen overnight. In terms of from an index standpoint, I think for us, there is probably room to try and align some of our philosophies with our U.S. indexes, and we've had these existing Morningstar indexes, including our international indexes, for a long time, and I think there's a lot of appetite for more challenger brands in Europe, specifically for companies like a Morningstar, because there's a few big index brands right now who predominantly own this market, and to be honest with you, they have a lot of bad reviews from their clients, because I think they have kind of lived off of inertia of their indexes, where really how they've kind of grown is really just increasing their prices for their developed markets or emerging markets indexes. These brands that have been around a long time that are very sticky, but they haven't succeeded off innovation necessarily. They've really succeeded off of monetizing these things because it is, these are sticky. They're hard to, for your portfolio manager, you've been using a benchmark for 10 years. It's hard to switch, but they've kind of ridden that wave. And I think there's a lot of appetite for companies like Morningstar who are a lot more flexible commercially, but still have a great kind of brand and great kind of index offering.
So I want to talk about sustainable investing, which I know you spend some time ESG type investing.
Yeah.
What's happened? It's fall off the cliffs. Sorry.
It's an area I remain, very passionate about and very interested in. I think if I compare when I came over to Europe in 6 years ago, the narrative has 100% change, right? There's been these, geopolitical, challenges. Of course, the US has totally flip-flopped in terms of its appetite for ESG, predominantly due to, the current administration. So things have radically changed in a short, period of time, which again goes back to I think economics change and, appetite and investor interest changes really, really rapidly, right? So we do a lot of studies on sustainability. So, the interesting thing is institutional investors, they still think sustainable investing is, material from a financial perspective. So I think in the long term, I'm still bullish on sustainable investing because I think the research that, folks like Sustainalytics do, where they're trying to really capture, what companies do for the long term, including, factoring things like, climate change and also like using their CapEx for, new projects that are, lower emitting. I think it still has a place in the market. Of course, it's not the, it's not the topic du jour right now. That's obviously dominated by AI and large, tech companies. But I still think it has a lot of room to run. And if you go to places like the Nordics, everything there still has some sort of sustainability lens. So I think it depends again, like where you're sitting in the world, but I'm still bullish long term. And I think I think some of the criticism with sustainable investing, sustainable data has been valid. And what I've seen the last 2 years is I think everyone in the industry has kind of recognized that and are more focused on the things that are more material from a kind of financial perspective. So will we see a huge, boomerang back to sustainable investing in the next kind of 2 years? No, but I think it's quietly going to continue growing because I think institutions are still committed. Even in the US, I don't think they're going to ring bells around it, but there's still, that some of the largest institutions are very committed to sustainable investing in the long term. And the reality is asset owners, these institutions, they drive a lot of capital. They do it quietly because, we can't always see kind of the moves that they're making, but I think they're still committed. So I'm bullish in the long term on sustainable investing. And there's still, I think, a lot of appetite in the market for a certain segment of investors. Even in the US, what's going to happen the next 10 to 15 years? You're going to see a huge wealth trickle down from baby boomers to kind of my generation, millennials, even younger than that. And I think a lot of people like me are still believers long-term in sustainable investing. So I think you'll quietly see a reversion. I don't think it's going to have kind of the big marketing boom it had, but it will still be there.
Well, one of the interesting things when it comes to about sustainability, I've actually had this criticism a couple of years ago. A lady came to me that's from a very active, sustainable background. And she's like, well, as a index manager or a passive manager, what are you doing on a sustainable front? Maybe touch on that because Morningstar Sustainalytics, that's your game. It's indexing and sustainability. What is the impact? What are you doing to sort of prove that you are actually driving sustainability?
Yeah, so I think there's a few things. I mean, again, I think, part of the issue with sustainable investing, it kind of got lumped into a single thing, right? I think sustainable, and I actually write a paper on this every year of different types of sustainable investing. And we try to be very transparent. Overall, if you look at our indexes, sustainable investing has really underperformed the last kind of 3 years, right? Because if you look at, especially some of the mega cap companies, companies like Meta, like they might be excluded for like governance reasons or underweighted because of their ratings. I mean, the reality is they used to be kind of ESG darlings, but now they are higher emitting. AI in general is not a, carbon friendly business to be in. So we've tried to be very, transparent. Again, I think indexes play like one part of it, but where we're trying to focus, I think our research and development is more on, and Sustainalytics as well, is more on things like materiality focused, things like climate and looking at more kind of tangible things. One thing I like that Sustainalytics is doing is looking at things like CapEx and OpEx for new projects, which companies are actually not just committing to things, but actually putting money towards new projects, and also not just having a purely like, oh, let's exclude fossil fuel approach. I think we're moving towards more, I think, tangible information for the companies, so you can actually evaluate what Total is doing versus what BP is doing from kind of a fundamental investment standpoint. And again, so you can make a better bet of like, I'm going to bet on, this company in the 5 to 10 year period. And I think it goes back again to institutions because they have that really long holding period. For a retail investor, they might not care about this information, right? If they have a 12-month holding period, but for an institutional investor who's in it for the long term, I think they do want to know these companies that are doing things that are thinking about 5 to 10 years out. We've spent the summer in London, right? Climate change is a real thing. It's going to impact the economy in a lot of ways. I've bought 2 mobile air conditioning units already this year. If you tell me like, climate change is not going to impact the economy, I would challenge that, right?
But what is the problem that we were trying to? Is the problem that there is a fundamental conflict between, seeking financial return and also social and environmental return in the same bucket?
Yeah.
So in other words, what we saw, and I remember, we had a firm that had I'm talking, like 10 years ago, that I had an ESG portfolio that we had, help them construct. And every year they would measure this portfolio against the standard, market portfolio. And the ESG portfolio was outperforming, And I was saying to them, well, there is no reason why mathematically it should outperform. My expectation was that both portfolios were going to be kind of, similar, if anything, maybe slightly lower on the ESG.
Yeah.
But anyway, we went through this like 5-year spell that they got drunk on this outperformance, and then mean reversion or reversion is mean started taking place, and the market portfolio started outperforming, and then they started losing faith in the old ESG concept, and we saw this massive shift away from ESG. So my point is like, is there a fundamental, conflict between seeking higher or high financial return as well as social and environmental return? Isn't the reward for ESG investing? The reward for virtue should be virtue rather than saying, I want to eat my cake sort of and have it.
Yeah, I think it's a great point. And I think that's where, like, if I look back as an industry, like we made a mistake in terms of like language is so important, I think, in the world of investing and being very clear, the outcomes you're seeking. And again, I think we lumped all of these different sustainability things together, right? Where there's a spectrum, right? There's, you could say values alignment falls under this kind of broad, so you could be, aligning to your faith, for example. So I want, broad-based exclusions, and I'm going to live with the consequences of excluding fossil fuels, right? Like some years you do well, 2022 you'll do terrible, 2025 you'll do better, but maybe some years you'll have that, right? So there's kind of that bucket of like true values-based alignment And so I think that still exists, but that kind of got lumped in with everything else. So, if you look at like the ESG ratings that were out there at the time, they were very broad based in what they were capturing, right? Like and I think we could have done a better job as an industry of what those things were actually trying to do, which was not have anything to do with virtue signaling or anything like that. It was trying to capture these more economic things in terms of very broad-based signals of environmental, social, and governance. I think the one thing I would maybe go back and challenge is like, was that best to kind of lump those things together or not, right?
Right.
And I think we should have been more clear as an industry on what outcomes we were seeking, because it wasn't, especially as the next provider, we never promise alpha of things. All we promise is giving you the exposure we're going to, which was, in this case, for a lot of our indexes, broad-based exposure with, overall better scoring companies to these, sustainability metrics, right? So I think a lot of this got lost in language and nuance, and it was almost a victim of success, I think.
Right.
If you look back in 2016, there was kind of kernels of success, and then all of these things came to market, and they happened to outperform for no reason due to sustainability.
Right.
So I think sustainability was almost a victim of its own success, and then I think people, woke up and took a little bit more of a practical view, to your point, and saying like, okay, is the success due to these sustainability metrics? No, it's just circumstantial that like, we overweighted technology companies.
Yeah.
And so it was much more macroeconomic. So I think, I'm looking more forward to like the 2.0 version, which is more tangible, more practical. I think that's where the industry is heading. Again, I think Sustainalytics is doing a good job of kind of where they're investing their time is those kind of things. So I think learning from maybe some of the mistakes there, and again, for kind of this more 2.0 version. But I can tell you again, there's still lots of institutional investors who believe in this, and there's still lots of investors who want to value, align their values. Morningstar just put out a great paper on faith-based investing.
I downloaded it last night. I haven't read it yet.
Yeah, which is really interesting. And for example, we developed a benchmark with the Vatican Bank, and that that's gotten a lot of attention. So I think there's a lot of interest in things like faith-based and aligning your values to your investments still.
Yeah.
Good. I want to pivot back to benchmarking.
Yeah, please.
if that's okay.
Yeah, of course.
So, and this question now probably comes more from a personal ick that I've had. You've alluded to the CFA is doing a very good job to state what a good benchmark is.
Yeah.
And trying to recall those criteria. I can remember transparency, investability,
specified in advance,
rules-based.
Yeah.
And if you take all those criteria, the best benchmark you can come up with is a broad market index.
Yeah.
It's transparent, it's rules-based, it's investable, you know what you're investing in. Now, here's my big problem with this. Active managers, they sort of exist because they believe they can outperform the market.
Yeah.
Yet, almost nobody, and I can't think of a active fund that are using a broad benchmark or a broad index as a benchmark. It's always a peer index or a peer benchmark. Why is that? Why aren't we seeing a broad benchmark of global equities or UK equities as a benchmark for the average active fund out there?
Yeah, I mean, I think this is where it would be a very beneficial area for regulators to step in, if I'm honest with you, because I think that, to your point, peer group averages, I'll call them, don't tell the full story. And a lot of these peer groups are also very, broad. If you look at, large, U.S. large cap equities, there is a range of different strategies that fall within that. So they're not a great peer group. So I would 100% agree that I think, whenever we talk to, an asset manager, say you can use that thing, but that's not really telling the full story. So there are places in the world that do require you to have some sort of true benchmark. And I think from a transparency perspective, that is the right, thing to do. Even Morningstar, like every one of our categories, we have a, we don't just calculate the peer average. We also have a benchmark assigned to every single one of our Morningstar categories. So that information is available out there. So I would 100% agree with you, because those are, there's a lot of flaws with those. A lot of them include, fee calculations, So they're not
or assets that you can't invest in.
right. You can't. None of that. You can go and buy. The peer group average. Right. Your alternative is a passive vehicle. So yeah, I would 100% agree, and I think that is where industry bodies, regulators can and should be out telling that message that because you're somewhat, I don't want to say, you're not giving the full story to investors, right?
This conversation, it just dawned on me that you've asked Rob Turkey to vote for Christmas, in the sense that I love Morningstar business model because you win whatever they do. Like if they benchmark, if they benchmark against per group averages, you're there.
Yeah.
But you really want them to benchmark against, broad-based market indices, you're there as well. Whatever they do, you win.
We do a lot of we do a lot of different things. So we're obviously in a good position, but ultimately we want what's best for investors. I think again we have both options. We want you to pick the better option. So, we want to make sure they know they have both options.
Yeah.
But to your point, I mean, I think one is a true passive alternative, one's not. So
and it's even worse. Just to it's a serious topic. It's even worse when you get to the DFM. DFM. Maybe
totally.
God forbid MPS market. In the sense that I've seen people benchmark against. I think it's called Apkims and all this industry benchmark. It's just why is anyone doing this?
40 to 85% equities.
Yeah.
Right.
Yeah.
The 60-40 benchmark is very convenient.
Yeah.
And so, that's why, 7-8 years ago, one of my first projects I worked on is trying to develop better, multi-asset benchmarks. It's hard because every client's different, but just having some kind of passive alternative where you can, in theory, easily go out and buy the building blocks to these multi-asset benchmarks and replicate them at a much lower cost than buying active funds. So that's something that we've been trying to do for a long time. We also work with PIMFA, the UK Wealth Management Association, on different benchmarks there. So we're trying to have more kind of pre-canned alternatives. Also, if you're a financial advisor, just for scale purposes, you probably also don't have the time always to create your own benchmark, blend them together. You also there's licensing costs and it gets really ugly really quickly. So we've tried to have better alternatives for those who don't have something or don't want to make something themselves.
Yeah, Rob, it's been so great.
It's been fun. Thanks, guys.
Yeah, we should have you back. By the way,
anytime.
I want to talk about private assets and all the work that you're doing on that.
It's the next frontier. So we can spend
the next frontier.
We can spend it on that. So I'll just quickly say that is something that not just Morningstar but other index providers are putting a lot of effort into. I think when you talk about SpaceX, you could foresee a future in 5 to 10 years where retail investors want access to these companies before they go public, right? And right now, that's left for institutional investors. So
at a reasonable cost.
Yep.
Interesting. Maybe we're going to get an index for private assets. That would be fascinating.
Thanks, guys.
It's been great to have you, Rob Edwards. Thank you for
It's been a pleasure.
Thank you very much.
Thanks, guys.
That's a wrap on today's show. Massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market-leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.